Investing in the stock market can be a great way to grow wealth over time, but it's essential to decide whether to invest a lump sum of money all at once or wait for a dip in the market. Both strategies have their advantages and risks. Here's a breakdown of each approach. 1. Investing a lump sum all at once. What it means. This strategy involves investing your entire amount of money into the market at one time, regardless of current market conditions. Advantages. Historical performance. Studies have shown that lump sum investing tends to outperform dollar cost averaging, DCA, in the long term because the market generally rises over time. If you invest all your money at once, you benefit from the full growth potential of the market. Immediate exposure. You're immediately exposed to the potential growth of the market, allowing your money to start working for you right away. No waiting. You avoid trying to time the market, which is extremely difficult to do consistently. Risks. Market timing. Risk. If you invest right before a market downturn, your investments may lose value in the short term. For example, investing right before a recession could result in significant losses. Emotional stress. If the market drops after a lump sum investment, you might panic and sell at a loss, which is detrimental to long-term investment success. When to consider. If you have a long-term investment horizon, 5 to 10 years or more, you can afford to ride out any short-term market fluctuations. If you're confident in the market's long-term upward trajectory and don't want to miss out on potential growth. If you believe the market is relatively stable or in an uptrend at the time of investment. 2. Investing in a dip, market pullback. What it means. Investing during a dip refers to putting money into the market when prices fall or during periods of market correction. A dip is generally considered to be a drop of 5 to 10% in a market index, while a bear market is a decline of 20% or more. Advantages. Lower entry point. You're purchasing stocks at a lower price than they were previously, which gives you the potential for higher returns when the market recovers. Less risk of immediate loss. By investing during a dip, you're buying at a discount, reducing the chances of immediate loss when the market rebounds. Potential for stronger returns. If the market recovers quickly, you can earn significant returns on your investment due to buying at lower prices. Risks. Difficult to time. It's very challenging to predict when a dip is truly over or if the market will keep falling. Trying to time the market perfectly can lead to missed opportunities. Uncertainty of recovery. While many markets eventually recover, there's always a risk that the dip might turn into a more prolonged downturn, like a recession, which can delay or prevent a recovery. Emotional pitfalls. If you wait for a dip and it doesn't come or takes longer than expected, you may miss out on strong market growth, leading to feelings of regret. When to consider. If you're willing to wait out the market's volatility and have a longer time horizon to ride out a recovery. If you believe the market is currently overvalued and is due for a pullback, allowing you to buy at a better value. If you have a long-term perspective and believe that investing during a dip will pay off once the market rebounds. 3. Combining strategies. Dollar cost averaging, DCA. What it means. Instead of investing a lump sum or waiting for a dip, dollar cost averaging involves investing a fixed amount of money regularly, e.g. monthly or quarterly, regardless of the market's current price. This spreads your investment over time, buying more shares when prices are low and fewer shares when prices are high. Advantages. Mitigates timing. Risk. DCA helps reduce the risk of investing all at once just before a market downturn. Removes emotion. By setting up automatic contributions, you remove emotional decision-making from the process. Reduces stress. DCA is a good strategy if you want to avoid the stress of waiting for dips and trying to time the market. Risks. Potential for lower returns. Since DCA means you might not take full advantage of market rallies, you could earn lower returns compared to lump sum investing, especially in a rising market. No immediate exposure. If the market is in a long-term bull trend, you might not capitalize on the full potential of the market's growth by spreading your investment over time. When to consider: if you're risk-averse and prefer a more systematic and predictable way of investing. If you have a long investment horizon and want to avoid the emotional stress of large market swings. If you're regularly earning income, e.g. through your salary, and prefer to invest consistently over time rather than in a lump sum. 4. Key considerations for deciding between lump sum and dip investing market conditions. If the market is near all-time highs and showing signs of a potential correction, waiting for a dip might be appealing. However, if the market is undervalued or has recently experienced a significant pullback, it might be a good time to invest more heavily. Time horizon. The longer your investment horizon, the more you may benefit from lump sum investing because you have time to ride out short-term volatility. Shorter-term investors might prefer waiting for dips to reduce risk. Risk tolerance. If you're more risk-averse, investing during a dip or using dollar cost averaging could reduce your exposure to market fluctuations. Amount of capital. If you have a large sum to invest and are unsure about timing the market, dollar cost averaging might be a safer choice. For smaller sums, lump sum investing might be more effective in capturing growth. Conclusion: lump sum investing. This is best for investors with a long-term perspective who are comfortable with the risks of market volatility. It allows you to take full advantage of market growth from the moment you invest. Investing during a dip. This strategy works well for those who are more patient and believe the market is temporarily overvalued. It gives you an opportunity to buy at lower prices, but can be hard to execute perfectly. Dollar cost averaging. This is a great middle ground for investors who want to mitigate risk and avoid emotional decision-making while still participating in the market's growth over time. Ultimately, the right approach depends on your individual goals, risk tolerance, and time horizon. For most long-term investors, a combination of lump sum investing and dollar cost averaging over time is a sound strategy to take advantage of market growth while managing risk.